You might remember the dot-com bubble back in 2002. It wiped out more than $5 trillion of investor wealth. It was a time filled with excitement. The internet was new, full of promise. Everyone wanted a piece of the action. But when the bubble burst, a lot of people lost a lot of money. Fast forward a few years to 2008, something entirely different, but just as devastating happened. The financial world faced an earthquake of a crisis. Unemployment shot up, housing prices crashed, and the global economy was rattled to its core. The effects of that crisis echo even today. And then, just when the world was starting to heal, COVID-19 hit, throwing everything into chaos. So here's the big question. Are we headed toward another big market crash? The answer is yes. But this one might not look like anything you expect. When you look back over history, every major market crash has left us clues, warning signs that things are out of balance. From the Great Depression in 1929 to the 2008 meltdown, certain patterns keep showing up. Today, while today's market shares traits with both the 2000 dot-com bubble and the 2008 crash, there are clear differences that make this situation unique. Right now, excessive speculation and sky-high stock prices are showing up again, especially in technology. This time, though, it's fueled by excitement over artificial intelligence. It reminds me a lot of the late 90s, when a handful of tech companies drove the market up based on internet fame alone. Back then, investors were hooked on the internet's potential, and now they're chasing AI's promise in the same way. Some people are hanging on, hoping to squeeze out every last bit of value before the bubble bursts. Financial experts warn that this AI bubble could actually be even bigger than the dot-com bubble once you adjust for inflation. The market's valuation has reached historic highs, raising serious questions about whether prices match the reality of the risks that lie ahead. If we rewind to 2008, remember, it was a housing and credit bubble that inflated the economy. The foundation was unstable, and when it cracked, it sent shockwaves throughout the financial system. Today, speculation remains enormous. Leverage, the amount of borrowed money in the system, and government debt are higher than ever, increasing the risk to financial stability. Even with tougher regulations and stronger banks since 2008, many investors still act like risks don't matter. Instead, they chase short-term returns, ignoring the bigger picture. But there are some differences this time around. The bubble is not in houses or loans. Tech and AI are at the core now. And unlike the early 2000s, many of today's tech leaders are profitable and have solid foundations. However, persistent inflation and high tariffs might make central banks keep interest rates high for longer than usual, creating new vulnerabilities. Also, commercial real estate problems now are worse than what we saw in 2008, a warning sign to watch closely. Some of the world's sharpest market watchers have sounded the alarm. Jeremy Grantham, famous for spotting market bubbles early, calls today's US stock market a super bubble, driven by AI hype, and expects a fall of over 50% when it bursts. Gary Shilling warns about excessive speculation and forecasts the S&P 500 could fall about 30%, pointing to weak jobs reports that suggest a recession could hit within a few years. But when exactly this will happen? Nobody really knows. Some think it could hit any time between late 2025 and 2027. Predicting the exact moment a bubble bursts is nearly impossible. Financial pros disagree. Some predict big drops soon. Others think the market can keep climbing through 2026. So what should you do to prepare? Experts agree that managing risk and staying calm are more important than trying to time the market perfectly. Having a solid emergency fund means you're less likely to panic sell when markets dip. Paying off high-interest debt can help ease financial stress if the economy slows. Diversifying your investments across different assets like stocks, bonds, and safe havens, such as U.S. Treasury securities, provides a cushion against sudden shocks. Look for quality companies with strong finances and use smart strategies like dollar-cost averaging to ride out volatility. Above all, keep a long-term view and don't let fear rule your decisions. History shows us that crashes change shape, but market cycles and human behaviors tend to repeat. This next crash might be different in cause and effect, but understanding the past while thinking ahead can help you protect and even grow your wealth.